Hey, we are live for our Lunch and Learn series on Phoenix REIA and also on my Just for Flips YouTube channel. If you're watching on YouTube, please go ahead and hit that subscribe button. And if you're watching on Phoenix REIA, welcome back and welcome to episode 4 of our series on buy and hold. Today, we're going to jump into why it is important to become bankable. Obviously, the cheaper money you get, the better off you are in this business. A lot of you guys start out with me as a hard money lender. That's probably the most expensive place to start, but we just look at the asset. We don't look at credit score or if you've done deals before or anything else like that. We just look at and go, do we like the house? And if we like the house, we'll lend on the house. But as you progress in this business and you add, you're doing some flipping and you decide to add some buy and hold assets, long-term, short-term rentals, commercial properties, whatever you're trying to do, getting cheaper money from the bank is super important. So that's my little introduction. Go ahead, Oggie. Let's jump into it.
Yeah, you're 100% correct. The last episode, we talked about why you should never buy and hold properties with cash, and we went pretty good examples of how leveraging money from the banks it's actually going to increase your ROI, and it's going to give you a lot more security and protection from inflation. So that being said, if you're planning to buy rental properties, it doesn't matter how much cash you have. Eventually, you're going to have to work with the banks. There's no other option.
Yeah.
So, big part of the buy and hold investing education is to learn how to work with the banks, how to be financeable, or what we call how to be bankable. So when you walk in every bank, show them your tax returns to set up and everything, and they like you and they can give you an unlimited amount of loans, whatever you need. So the first step of being bankable or to be able to get a lot of financing from the banks is actually your tax returns. So you need to start filing taxes the proper way so the banks like you. And just having a good tax guy actually is not enough. That leads to having a good attorney that you can set up the proper legal structure for your business, so you're flexible. Because if you don't have a flexibility in your LLCs, holding companies, S corporations, your tax guy cannot do anything. Doesn't matter how good they are, they cannot move around money, they cannot move expenses, and it's very, very hard for you to become bankable. So the first lesson, you need to have a good tax guy and you have a good attorney so you can have a proper setup in order to have flexibility and to become bankable. So now let's talk about the actual financing, investor financing. And for us, in order to get the most return on investment, what we want cheap money. And for the purpose of this call, we're going to talk specifically about how to get the cheapest possible investment loans. And that's from Fannie and Freddie, or conventional conforming loans. That's what everybody says. Right. We're not going to talk about DSCR. We're just going to talk about conventional financing, very straightforward conventional financing. So we're going to talk about the specific rules, the specific things, what the bank want. So in about 30 minutes, I think we're going to give you a pretty good idea what to be careful for. And when you go and sit down with your mortgage guy, so you can have intelligent conversation about, your real expectations. So first thing first.
That's 10 loans. Are you just talking about that first 10, or is there a way to get past 10 on this stuff?
Yeah, so we're going to talk about the first 10. Fannie and Freddie, as a conventional financing, they don't like to give more than 10 loans per person. So the way we do it is when there's a husband and wife or spouses, and with the first 10 properties we purchase on one person, And when this person is done, then we move and buy 10 more properties on the other person. So once you get to 20 properties as a family, then you can go into a commercial bank, wrapped up these 20 properties into one big commercial loan and take them off your personal credit. So any commercial loan doesn't go on your personal credit. So when you take them off your personal credit, Fannie and Freddie can give you another 20 loans, 10 to you, 10 to your spouse, and that's how you keep the system running. So let's talk about the first 10, how you get financing from the bank, what the Fannie and Freddie are looking for. So there are 4 things that you have to be ready for. First one is income, employment, the first 2. Then the bank is looking for your assets, and at the end, they're looking for your credit. So let's talk about the income. W-2 versus self-employed. If you're on a W-2, which means you have a salary, you're getting paycheck, it's very easy to get qualified based on this income. The bank has a requirement only for 2 consecutive pay stubs, and they can take this income in consideration. The story is different if you are self-employed. So if you're self-employed, they want you to have 2 years of tax returns. So, but there's an exemption also to 1 year possibility if your self-employed LLC has been in business for 5 or more years. So then you can go away from, instead of 2, going down to 2 years. But it is harder when you're self-employed to qualify, especially when you're quitting your job and moving as a self-employed. That's going to be pretty hard. It's way easier if you're a self-employed person going to a salary. Then you have to show only 2 consecutive months of pay stubs, and that's perfectly fine. Here's another problem. When you're getting hired from a family member, then the rule doesn't apply. They still want you to have 2 years of tax returns. So be careful when you setting up your employment, or you're thinking of quitting a job and live off from the rents. Be careful. You might not be able to buy a lot of properties. You might not be able to get the income accepted by the bank. So another problem I'm thinking about is what a self-employed is. If you have a really good business as a self-employed person in one area and you're relocating to another area, you got to be careful, because the underwriter might have a problem because your business is not established in the new market, and they might have questions about if you're going to be able to make the income really, really good. So
yeah. So when you talked about the first 5 years, so you were talking like, hey, if you're W-2'd and you were running your kind of business as a side hustle for 5 years, then they'll let you get away with that 1 year.
Correct. Yes.
Got it. Okay.
You have to prove, and usually that comes from a letter from your CPA.
Okay.
So having a good tax advisor, CPA, it's a really important to have as a part of your team. Like, Chris, hard money guy, has to be part of your team. Good tax guy, good attorney, good broker, good mortgage broker. Yeah, all these people you have to establish a team before in order to successfully buy a lot of properties. So
yeah.
Let me give you some tips on how to find more income in your tax returns. So, for example, as a buy and hold investors, we own rental properties. But a lot of these rental properties and a lot of the expenses that we already have for our business and we get tax returns are considered actually income. So we use these expenses to reduce our taxes, but when we go to the bank and apply, they take these expenses and they move them to the income column. So the first expense, the biggest one, is the depreciation. So when you own a rental property, it's a business. IRS requires you to depreciate the building. All this depreciation reduces your taxes, but when you go and apply for mortgage, that depreciation is considered income. So that increases your income. Another thing that is expense and income is miles. all your miles, if you take the deduction for your car based on miles, which I think this year is going to be around 60 cents. Let's say you drive 1,000 or 10,000 miles, 60 cents, $6,000. That's a deduction on your taxes expense. But these 6,000, they get added to your income at the end of the year. So depreciation, miles, home office. If you have a home office that you're deducting a quarter of your home as a expense, that thing is also added as an income that you can have. And any other amortization on the business is any items that you have that you amortize. There's amortization and expense that could be added to the actual income at the end. So,
so you're just talking about add back. So like when I drop
yes.
$30,000 into my 401k, they'll actually, because I don't actually have to put it in there. That's just what I choose to do, right? So I can deduct that off my taxes, but they will actually add it back to your income when you're qualifying for properties.
Yes, but I'm talking about actual expenses on the tax returns that the expense and the reducing your taxes, they could be added, not just invested. Yeah. Another thing that if you have a good experienced mortgage lender can help you add to the income is one-time home repair expenses. So you buy a rental property and you put 30,000 in the rehab. This 30,000 is an expense for the business, reduces your taxes, but because it's just one-time expense, it could be taken off and added as an income. And a good mortgage guy can argue with the underwriter and add this income to your overall bottom line. So it's good. Another thing that when you're applying for a mortgage for investment property, the bank is willing to take the future rental as income in specific situations. So
you don't have to wait a year? I thought you had to wait a year. No, you can.
There's certain rules. Rule number one, if you own a property already, any type of property, personal residence, they automatically will take 75% of the future rental income to help you qualify. And they're not going to, that's why 75, because 25, they consider vacancy, repairs, expenses, property management. So 75% of the future rental could be taken in consideration when you are applying for a mortgage. So but they want you to have history. If you own a property like a personal residence, automatically qualify. If you don't own a property, they will not take this future rental income in consideration. It's going to be harder for you to qualify. You need to show a pretty good income. Another income that you can add to the column to increase your income is if you can prove that some of your expenses are paid by somebody else. For example, I have a lease on my car, but it's paid by my company. The lease is under my name, but the money comes from my checking account, from the bank, from the LLC's bank account. You prove with the statement that you're not personally paying for it, the company is, and then you can increase your income by removing this expense from you because you're not personally responsible. Even though it's under your name, under your credit, your company is paying for it. Same thing. Or if somebody else is paying, co-signer or something like that. So,
gotcha.
So that's how you look for increasing your income. Things that you use to reduce your income for your tax returns, you can move these things back and increase your income so you can buy more properties. Makes sense. Yeah, this is so far for income and employment. There's a lot of little loopholes and things we can talk about, but could take a whole day. So let's move to assets. And assets, when I talk assets, I'm talking about cash, money. That's what the bank wants you to have. So if you're going to be using certain amount of cash for down payment, the first thing you have to remember is the bank wants seasoning. They want to know where the money came from. Or so the best way is to have the money in your bank account for minimum of 3 months before you're buying property. Then you don't have to prove anything. If you deposit money 2 weeks before the closing and to use for down payment, they want to see a trail where the money came from. Bank account after bank account after bank account. And you have to write explanation and things like that. So the money that you're going to be using as a down payment, please have them seasoned. Be prepared. At least 3 months in your bank account so you don't avoid a lot of questions. Another thing that the bank is going to ask you to have is 6 months of reserve of mortgage payments for each investment property you own. Or actually, no, not just investment. Each property that you own, every mortgage, including your personal residence. So if you have,
might be a lot of money.
Could be, you have to be ready for that. For example, we have one property, mortgage payment is $1,500. They want to have you what, 7,500? No, 6 months. Yeah, so around that for in your bank account as a reserve. But if you have 10 properties, in order to buy the 11th, they want you to have $60,000, $70,000, $80,000 cash in your bank account. So
on top of the seasoning money.
Sorry?
On top of the seasoning money.
On top of the seasoning money, yes. That's a reserve. After you set it down with the closing, you need to have extra money so it can be, you'll be okay. Remember, gifts are not allowed for investment properties. When we're buying a normal property to live in, we can get a gift from our cousin or family member, but in investment properties, it's not allowed. So what you can do here is, if you don't have the assets, but let's say you put the money into investment accounts, 401k, IRA, and everything, something like that, or stocks, if it's a liquid asset, then you can use this as a reserves. Let's say you have a 401k that's 100,000, and the bank wants to have a requirement of 6 month reserves for all your 10 properties, about 70,000. You can show them the retirement account, and that's going to satisfy them. It's going to be perfectly fine. But right, it's a big issue, big problem that you have to be ready for. So another thing is, if you're selling a property and the money is coming from escrow, that's another way that you can show that where the money is. Yeah, where the money is coming. So so when you have here's an interesting way to not to get the money sourced. So let's say the wife is buying the investment property, and the wife has to prove 6 months of reserve for the properties. And let's say the family has 10 properties. She has to prove $60,000, $70,000 cash in the bank account, but they have only 10,000. If the husband puts the money in, and remember, in case of the wife buying the property by herself without the husband, only she's qualifying. If the husband puts the money into the joint account, the bank is not going to ask you for seasoning and the source of where the money came. The only thing is going to ask who put the money in. The spouse put the money into the joint bank account. Then it's allowed. It satisfies all. There's no seasoning and satisfies the rules. So you're perfectly fine. Just a little loophole. So otherwise, you just have to explain all the paper trails. Be ready for that. Be ready. So assets. Let's talk about the real credit score. Credit score is
real credit score.
Man, credit score, I would say out of everything we spoke about so far, credit score is the easiest to fix. With the right knowledge, the right people, we can rescore a person with 3 to 7 business days and get you. And we have some little tricks and tips that you can increase your credit score with 100 points in very, very quickly. So you should not worry about so much about credit score, but you have to be careful and know the rules. The better the credit score is, the better interest rate you'll get. You might not get denied for a loan. You're just going to get either better or worse interest rate. That's the difference for the credit score. I believe the minimum we can do is 620, which is not going to give you a lot of good rate, but everything over 720, 750, then you're going to get the best possible rate as you can. So one thing that I'd like you to guys remember and talk to your mortgage guy and prepare for getting an investment loan is, do not pay old collection accounts. So let's say, because if the collection account is 5 years or older or something old like this, it falls out of the report, kind of. It stays there, but it's not calculated. If you pay it, it pops up again on the credit score, and actually it's going to hurt you, your credit score. So that's the rule at the moment. I'm not saying it cannot be changed.
Is that with all creditors, or just like medical, or
old? I mean, no, timing, old ones.
Okay.
5 years old. They've been sitting there for a long time. If you pay them, they resurface again, and it's going to hurt your credit score. So consult with your mortgage guy before you're doing anything on your credit, paying anything, any debt, anything like that. So, of course, the biggest thing is don't be late on your mortgage. Don't, that's the biggest. If you're 30 days or more late, it's a pretty big thing. If you're 3 months consecutive late on your mortgage, the bank considers this as a foreclosure. It has the same hit on your credit as a foreclosure. They're going to deny you. It has to have 1 year of consecutive good payments before they consider you for financing. So if you have 3 months consecutive of not paying your mortgage, that's not good.
Well, if you go get a foreclosure, it's 7 years before you can get a conventional loan. I don't know if anybody knows that, but
yes, yeah. Real foreclosure, foreclose on it's going to take time. Yes, FHA 3 years, but for investment we need conventional. So, also, if you're both of like husband and wife or spouse, they're buying a property, they're going to check the credit for both, and they're going to use the lowest credit score. They're not going to use the best. They're going to use the worst. So, everything needs a little planning before you go and try to buy a property. Talk to your mortgage guy. Make sure it's all the little things are there, and you're fully pre-qualified, and there'll be no surprises for you, or you lose your earnest money, or miss a deal, or something like that. So, but here's I'll finish with this tip, which is perfect in this situation, this time of year. Do not ever file your taxes before your mortgage guy reviews the taxes. What you do is go to your tax advisor, CPA. Have your taxes prepared, put them as a draft, and send the draft to your mortgage guy and say, hey, this year I'm planning to buy another rental, 2, 3, 5, 6, 10 rentals. Based on what I'm planning to file to IRS, would you be able to approve me to reach my goal? Then the mortgage guy says, yes, you're perfect, or no, you're showing too little income. Then you have the time to react. Go back to your CPA, talk again, figure out, hey, can we reduce these expenses, show more income, and just move the things around so you can get qualified. Because once you file your taxes, it's really hard to redo it, and then you're going to be stuck for these particular numbers for the whole year. So never ever file your taxes unless your mortgage guy approves them. that's what I have for today, guys.
There's
But
a good tip for you guys.
yeah,
You know,
so
basically, he's basically saying, hey, the guy that's going to be underwriting your loan and getting your loan, have him just review your taxes to make sure something that's not out of place that the bank's going to say, no, this is a red flag.
yeah, exactly. Like imagine, so like I said, in order to be bankable, you need a good tax advisor, you need an attorney, and you need a good mortgage guy. Because, for example, if you're not structured properly, like the way I was in the very beginning, my tax returns were 500 pages. 500 pages with all the LLCs, all the rental properties, everything. Imagine if you give 500 pages to the underwriter.
He's going to know.
They're
Not know
going
what
to
to
be
do with
lost.
it.
So what I did, we legally restructured all the companies. And now all we give is 15 pages. We still have 500 pages. We shrink it down even way more. But now what we give is 15 pages to the underwriter based on what they need. The rest we just hold it if they want it. And that's how so having the proper legal structure makes it easy for the bank to approve it. You just have to help them. You have to play by the rules, or just go around the rules. I mean,
yeah. All right, guys. Well, thanks for jumping on. You got something for us next week too, or what do you we got it?
Oh man, we have good stuff coming up. So I don't know. We'll see. What do you, anything specific you want to talk about?
I mean, if you can go into maybe, I know short-term rentals or, leasing best tips, anything like that you can think of that we should jump in.
We can come up with something. And if somebody has any specific questions, you have specific scenario, something you guys want us. Yeah, comment below or give us a call. Let us know what the situation is, and so we can give you proper advice how to handle it. So
cool. Well, thanks for jumping on, Oggie, once again.
Yeah.
See you next week.
See you next week. Thanks, Chris.
Right. See ya.